and welcome. I'm Andrew Betwain, the editor of fundoperator.com, and today I am joined by Robert Hulme, who is the Responsible Investment Engagement Manager at the West Yorkshire Pension Fund, who is speaking at our ESG Investment Leader Conference on the 15th September in London. Robert, hello, how are you?
Hi, good morning.
Thank you for joining us. So Robert is going to be speaking on a panel at the event called How Can Investors Prepare for the Energy Transition? So it's a wide-ranging panel discussion which is going to cover all the news and advancements that we've seen over the past year and the debate around the cost of living, carbon emissions, the European Union's moves on taxonomy, as well as the general moving to renewables that's been seen across the energy industry around the world. So lots to discover and lots to talk about. So Robert, I want to start with you by asking, what are some of the main factors that institutional investors must consider when it comes to energy transition?
Okay, well, local government pension schemes such as West Yorkshire have been asked to consider our approach to responsible investment for quite a while now. So that's essentially, how do we take an active interest in those companies in which we invest? How do we exercise our voting rights? And generally, how do we provide appropriate oversight to those companies? Now, clearly, climate considerations are part of the discussion. I think the arrival of the TCFD requirement is quite useful to shape institutions' approach to the energy transition. So it starts with the core idea that climate risk is indeed financial risk, and therefore we need to describe how we are accounting for such potential problems within the portfolio. So it really describes our approach to the overall governance of those threats, what our strategy is, what risk management concepts are in place, and which metrics we choose to focus upon. So I think it's a very good starting point for institutions to consider the implications for their own portfolios.
So a good starting point you mentioned there. So I want to build on that point with question two, which is what plans can institutional investors put in place? And this will cover everything from sort of stewardship and relationships with custodians through to the opposite side of what the market is doing and how they can react to one another.
Okay. Well, yeah, I think we just have to have a kind of a good sit down and consider the implications of climate change. There are a number of considerations, both in terms of disclosure. So most will be required for the TCFD form, which I suggested was a good starting point. There might be other regulatory obligations as well. Many will have made a net zero commitments. So there's a need for the awareness of the regulatory requirements. There's also a need to understand the frameworks that exist to potentially help companies and or investors. There's clearly a great deal of activity in terms of both developing frameworks, but also in terms of kind of data providers. And often it's kind of difficult to perhaps understand on one side what products are being sold to you, and the other it's kind of what are the outstanding frameworks designed to kind of help you. I suppose one key concept is also kind of materiality. Understand where the risks lie within your portfolio and try and mitigate those risks. But you need to understand, say, where the carbon intensity is within your portfolio, and then embark on appropriate engagement to help mitigate that problem in the future.
It's interesting. And then, of course, you have materiality, and then you have double materiality, which is the most joyful subject in the world to talk about. So building on that, how can institutional investors then appropriately evaluate the organizations and respond to that, and respond to the transition and make their decisions accordingly? And basically what I'm asking there is, what are the red flags that they should be looking out for about maybe companies that aren't using the transition, taking it seriously, or people who are laggards?
Right. Well, as I said, suggested, there are frameworks available that are very useful and often a good basis to start engagements with. So, if I was asked, I would say first and foremost, have a look at the Climate Action 100 list. They have identified the 180 or so systematic contributors to carbon, and they also provide an analysis in terms of the progress made by those companies. Similarly, the Transition Pathway Initiative takes that research a little further. They have a broader mandate, a larger universe of stocks, and they seek to assess management's commitment to climate risk, but also the carbon performance. So those are good places to essentially start. Similarly, science-based targets, they are very useful. The science-based target, essentially, a company has provided a plan and has submitted that for external scrutiny, and has been assessed as belonging to one of those pathways. The best pathway being the 1.5% degree centigrade climate change. So you've got some external validation. It's sector dependent, and that's also quite useful. So you do have that available. There are also many other kind of engagement groups where you can join as an investor. So it's definitely the burden of responsibility and reporting, and ultimately the responsibility for this will always lie with the investor. But there is many frameworks that will help people in that research. And for the great deal of investors who rely on third parties, then the fund managers will also be providing information also along those lines.
Thank you for that. So to what extent do investors need to make sure that their own transition plans are up to scratch here? So if you could talk us through that, Robert.
Okay, well, I suppose there's two aspects to this. Is to how do we decarbonise as an organisation? So what's our business travel? What's the carbon footprint of our building, etc.? I think we've got quite a small footprint as an organisation. The investment side, we've got 15 people. We're probably less than 40 in terms of the overall investment arm of the pension fund. So we've got quite a light footprint as an organisation. But the much more important element would be how we decarbonise the financed emissions of the portfolio. So our fund is around £18 billion. Our pro rata share of carbon is about 1 million tonnes. So it's about a few 100,000 cars, it has to be said. So we've got quite a big footprint. As part of our pool, the Northern LGPS, which is ourselves, Greater Manchester and Liverpool and Merseyside, we have made a net zero commitment. So we will seek to decarbonise by 2050. So we've got 30 years to do it. Now we could do it in a couple of days. It'd be very messy in the FTSE, it has to be said, if we sold £600 million of fossil fuel stocks. The important consideration here is not to decarbonise the fund per se, it's to achieve decarbonisation in the real world. So we seek to work with our big investments, the Shells, the BPs, etc., to ensure that they have an appropriate strategy to decarbonise. And we have been pleasantly surprised by the developments that we've seen over the last 12 to 24 months in terms of the seriousness of these of the company's plans, and they've in many ways led the decarbonisation efforts. Corporates often, particularly the European and UK ones, are often ahead of investor plans. and that's not necessarily the case with other geographies, particularly the US, but certainly it seems the companies are not just listening, but often leading the discussion, which clearly makes our job that much easier.
Some fascinating insights there into the way the market works, especially around those geographies and different ways it works. Thank you very much for your time, Robert. Those are all my questions. If you found what Robert was saying interesting, he'll be speaking in the panel discussion at the ESG Investment Leader Conference on the 15th of September in London. Please do go to ClearPath Analysis website for more information about how you can attend. And I'd just like to say thank you to Robert for his time today. I'm Andrew Petwain, the editor of fundoperator.com and insuranceinvestor.com. And once again, thank you for listening, and goodbye. Thank you very much.